Most investors are staring at a number right now and completely underestimating what it means. 5,000 XRP, it sounds ordinary, it sounds small, but what if that assumption is exactly what separates the people who build real wealth from the ones who watch it happen from the sidelines? The global financial system is quietly being rewired. Trillions of dollars, ancient infrastructure, and one digital asset positioned right at the center of that shift. The question is, are you already too late? There is a number quietly circulating in XRP conversations right now, and most people are brushing past it without a second thought. That number is 5,000 XRP. On the surface, it does not sound dramatic. It does not conjure images of massive wealth or whale-level portfolios. For a lot of investors, it might even feel like a modest, unremarkable target. But here is what makes this interesting. That reaction, the instinct to dismiss it, may be one of the most costly oversights a retail investor can make right now. Let us take a step back and look at what is actually happening in the broader financial landscape. Every single day, trillions of dollars move across borders. International wire transfers, cross-currency settlements, institutional payments flowing between banks in different countries. And yet, despite living in an age of smartphones and instant communication, that money often takes anywhere from 1 to 5 business days to arrive. Along the way, it passes through multiple intermediaries, each one adding fees and introducing the possibility of delay or error. It is a system built decades ago, and it has not kept pace with the digital world it now operates in. This is the exact problem XRP was engineered to address. At its core, XRP functions as a bridge asset. When two parties need to exchange value across different currencies, XRP can step in as the intermediary, settling that transaction in a matter of seconds rather than days, at a fraction of the cost of traditional methods. No correspondent banks, no stacking fees, no waiting, just fast direct settlement. That is not a marketing claim. That is the documented technical function of the XRP ledger, which has been operating since 2012. Now here is where the economics become worth paying close attention to. XRP has a fixed maximum supply. There will never be more XRP created beyond what already exists. This is built into the protocol itself. As global adoption of XRP-based payment solutions increases, whether through financial institutions, payment processors, or other real-world applications, the demand for XRP rises, but the supply does not. That dynamic, growing demand against a fixed supply ceiling is a fundamental driver of value in any asset class. It is not unique to crypto, it is basic economics. So when we return to that number, 5,000 XRP, it starts to look a little different. Right now, building a position of 5,000 XRP is still within reach for a meaningful number of retail investors. The price has not moved to a level where the average person is priced out of accumulation, but here is the reality of how markets work. The window where accumulation is accessible does not stay open indefinitely. And for most people, they will not recognize that window until it has already closed. This gets to the heart of one of the most persistent challenges in crypto investing, which is human psychology. Most retail participants are drawn to assets that are already moving. They respond to momentum, headlines, social media buzz, and rapid price action. When a token is trending, the conversation explodes. Everyone wants exposure. But by the time the general public is excited, the earliest holders have already accumulated their position at significantly lower prices. The opportunity was not in the excitement, it was in the quiet period before it. XRP has spent considerable time in that quiet period. And while the noise around other projects has come and gone in waves, XRP has continued building its underlying infrastructure. Ripple, the company closely associated with XRP development, has been expanding its network of payment partners, deepening institutional relationships, and navigating the regulatory environment, all while much of the retail market has been focused elsewhere. The progress has been methodical rather than viral, and that is precisely why it gets overlooked. Building a meaningful position in any asset requires a level of discipline that most investors simply do not sustain. Think about what accumulation actually demands. It requires buying consistently, even when price movement is flat. It requires holding through dips without panic selling. It requires ignoring the noise of trending alternatives. And it requires patience that runs counter to the instant gratification culture that dominates retail trading. Those are difficult habits to maintain, and the data reflects it. The majority of retail investors enter assets late, exit early, and end up with fragmented, underperforming portfolios. This is why 5,000 XRP as a target is more elusive than the number itself suggests, not because of the math, but because of the behavior required to get there and stay there. Reaching that accumulation level demands consistency over time. Holding it demands conviction through volatility, and recognizing its potential before it becomes obvious demands a willingness to do independent research rather than follow the crowd. Let us talk about something that does not get discussed nearly enough, the actual distribution of XRP among holders. A significant portion of existing XRP is held by long-term investors, early adopters, and institutional entities. These are coins that are not actively circulating. They are not sitting on exchanges waiting to be purchased by the next retail participant. The liquid supply, meaning the XRP that is actually available for everyday investors to buy on exchanges, is considerably smaller than the total supply figure might suggest. This matters enormously when you think through what happens if institutional adoption accelerates. Large financial players do not move capital in small increments. When a bank or payment provider decides to integrate XRP into their settlement infrastructure, they need consistent access to meaningful volumes. That kind of demand operating at institutional scale would put significant pressure on available supply. Retail investors who have not yet accumulated are then competing for whatever is left. When supply tightens and demand increases simultaneously, prices respond. That is not speculation, that is supply and demand mechanics. There is also the concept of network effects to consider. Network effects describe a phenomenon where a system becomes more valuable as more participants use it. The internet is the most well-known example. Email was worth very little when only a handful of people had access, and immensely valuable once billions were connected. Payment networks function similarly. As more institutions integrate XRP for cross-border settlements, the incentive for other institutions to join the same network grows stronger. Adoption does not move in a straight line. It tends to accelerate once it reaches a critical threshold. If XRP reaches that kind of adoption threshold within global finance, the conversation around what constitutes a meaningful position changes significantly. 5,000 XRP, accumulated quietly during a period of low public attention, could represent a stake that is genuinely difficult for late entrants to replicate. Not because the market is unfair, but simply because the supply available to accumulate is less accessible than it was before. Timing is a variable that almost no one prices in correctly. Most people think about timing in terms of short-term price movement, buy low, sell high, repeat. But strategic timing in a long-duration asset story works differently. It is not about catching the right week or reacting to the right headline. It is about being positioned before a fundamental shift in demand structure occurs. Once the market collectively recognizes that XRP has real utility embedded in actual financial infrastructure, the accumulation phase is over. What follows is a different kind of market entirely. It is also worth noting that the regulatory environment around XRP has been evolving. After years of legal uncertainty in the United States, the landscape has started to shift toward greater clarity. Regulatory clarity matters because institutional capital is compliance-driven. Large financial entities cannot allocate meaningfully to assets that carry unresolved legal risk. As that risk diminishes, the barriers to institutional participation come down, and as those barriers fall, more capital becomes eligible to flow toward XRP. This is a structural change, not a speculative narrative, and it takes time to fully materialize in market behavior. Now, it is essential to state clearly, none of this is a guarantee. Crypto markets carry significant risk, price movements are unpredictable, adoption timelines can extend far longer than any analyst projects. Regulatory conditions can shift, competition from other digital asset solutions is real. XRP is not the only project pursuing cross-border payment use cases, and there is no certainty that it will dominate that space. These are legitimate risks, and any investor considering a position in XRP should weigh them honestly before making any decision. What responsible investing looks like in this environment is not chasing a specific number or setting a rigid accumulation target. It is understanding the underlying thesis, doing independent research, sizing positions according to your own financial situation, and maintaining a time frame long enough to allow the thesis to develop without forcing premature decisions. No one should allocate more to XRP or any digital asset than they are genuinely prepared to lose. Volatility in this space is not the exception, it is the baseline. With all of that context in place, the core observation holds 5,000 XRP is not remarkable because of the number itself. It is worth examining because of what it represents, a position built with discipline during a period when most investors are not paying close attention, and an asset with a fixed supply that may be entering a phase of institutional scale demand. The investors who look back on this period with confidence are not necessarily the ones who invested the most capital. They are the ones who understood the mechanics early, acted consistently, and held with a clear sense of purpose. The broader crypto market has a persistent pattern. The people who benefit most are rarely the loudest voices in the room. They are not the ones chasing every trend or reacting to every price movement. They are the ones who identify a rational thesis, accumulate thoughtfully over time, and have the patience to let the market come to them. That is not an exciting story. It does not generate viral content, but it is how durable positions get built in any asset class, and crypto is no different. XRP sits in an unusual position within the digital asset landscape. It is not a newcomer without infrastructure. It is not a speculative token without a real-world use case. It is a digital asset with a clearly documented purpose, a fixed supply, an active development ecosystem, a growing network of institutional partners, and a regulatory situation that is gradually moving toward resolution. Whether that combination ultimately translates into the kind of adoption that meaningfully impacts long-term holders is a question the market will answer over time. But the foundational components are there in a way that does not exist for the vast majority of crypto projects. If you have been watching XRP from the sidelines waiting for more certainty before forming a view, it is worth asking yourself what certainty would actually look like, because in markets, by the time an outcome is obvious, it has already been priced in. The period where risk and potential reward are most favorably balanced is almost always the uncertain phase, before the narrative is settled and before the institutional capital has fully arrived. This channel will continue to track XRP developments, regulatory updates, institutional movements, and market data as they unfold. The goal is straightforward, clear, factual, grounded coverage that gives you the information you need to make informed decisions on your own terms. This is not financial advice, and we do not push price targets. What we offer is consistent, reliable reporting on one of the most closely watched digital assets in the market today. For more clear and reliable XRP updates, make sure to subscribe to our channel.